You requested a stack of shares, you got a scrap of it, and somehow you're supposed to feel lucky. You watched the stock rip higher the second it opened, and you thought what everyone in that comment section thought. I missed it. You didn't miss it, it already happened. To someone else. While you were still refreshing the app, waiting for the market to open. Here's what nobody explains before you tap request shares. By the time you are allowed to buy, the company has already been sold. Not to you. To a room you were never in. What lands in your account is what was left over. Some of you are furious about that. Some of you are just confused. You're both right. And maybe you weren't even tempted. Maybe you smelled the markup on that first day pop and stayed out on purpose. You were right to feel that. You just had the mechanism wrong, not the instinct. Because this isn't a story about a company letting the public in. It's a story about a line, one that formed months before you ever heard the ticker. And where you stand in it has nothing to do with how much money you have. And halfway down this line, there's a phrase, 5 words. Wall Street says them behind closed doors and never in a headline. When you hear them, you'll know exactly who the pop was for. An IPO isn't an entrance, it's an exit. It's a day the people already inside get permission to sell to the people who aren't. Let's walk the line. Start with the word because the word is hiding something. When your coworker says he bought the IPO, ask him one question. At what price? There are 2 prices in every IPO. They are not the same number. The first is the offer price, what the shares actually sell for the night before trading starts, set in a private room by the bank for a specific list of buyers. If you're on that list, you're in the IPO. The second is the opening price, what the stock costs the moment it starts trading the next morning. And that number is already moving. It's already swallowed a wave of demand. It's almost always higher, sometimes a lot higher. So you open your app on IPO day, you hit buy, you're not buying the first price, you're buying the second one. You are not in the IPO. You're buying a brand new stock on a wild first day from people who got it cheaper. Take a typical deal. Roughly 9 of every 10 shares never reach the public at the offer price, not one. They were spoken for before the exchange opened. So when someone says they bought the IPO, most of the time they didn't. They bought the aftermath and called it the event. So if not you, who? Who buys at that first price? Walk the line from the front. At the very front, the founders and the earliest employees. They didn't buy in, they were paid in. Shares that came with the job years ago at a price the company set for itself. Behind them, the venture funds. They wrote checks when the company was a pitch deck and a promise. They got their shares for a fraction of today's price. That's the reward for being early. Then the institutions. And this is the part people call corruption when it's actually designed. Before an IPO, the bank runs something called book building. It takes the company on a roadshow and asks the big funds one question. How many shares would you buy? And at what price? Their honest answers build the book. The book sets the offer price. Then the bank rewards the funds that told the truth with the shares. The allocation isn't a favor for being rich. It's a payment for helping set the price. You were never asked. Your answer was never going to move anything. Then one more group, and this one's a wall, not a rung. Accredited investors. There's a legal line in this country. Cross it and doors open that are welded shut for everyone else. Under the rule as it's written today, $1 million in net worth, not counting your house, or $200,000 a year in income, or a securities license. Read that bar again because it doesn't test what you think. It doesn't ask if you understand the deal. It asks if you can afford to lose money on it. It's a wealth test in the costume of a safety rule. And you're behind all of them. Not for anything you did, for which legal category your name fell into before the stock ever traded. So naturally, someone is selling you a way around that line. By now you've seen the ads. Invest before it goes public. Get in on the ground floor. Some of that is real. Most of it isn't the thing you're picturing, and the gap is exactly where the money gets made at your expense. There are 2 completely different products wearing the same 3 words, pre-IPO. The first is equity crowdfunding. A law passed in 2012 cracked it open, though it took regulators until 2016 to finish the rules. Now ordinary people can put small checks into early stage startups on certain platforms. This one is real and it's open to you, but look at what it is. tiny, unproven companies, money you can't pull back out for years. Most of them fail. It's a lottery ticket end of venture sold to the people who can least afford the bet. The second is what the ads are actually gesturing at. The late stage giant everyone already knows. The one you actually want. Its shares do trade privately on marketplaces built for exactly that. But to buy there, you have to be accredited. That wall again. And even then, you're usually not buying from the company. You're buying from an employee cashing out at a price you have no power to set. So the pre-IPO you can reach isn't the pre-IPO you want. And the pre-IPO you want isn't reaching down to you. The dream is real. It's just filed under a name you don't have the clearance to open. But say you skip all that. You just want the regular thing. Your broker has a button now. IPO Access. Request shares, so you request. Here's what that button actually is. A lottery. Your broker gets handed a thin slice of the deal. The retail carve-out. The leftovers after the institutions are fed. And far more customers want those shares than exist, so the broker rations them. On some apps, it's a literal random draw. On others, a ranking by how big your account is and how much you trade. Either way, requesting more shares does not improve your odds. That's not a rumor. It's written in the rules. Here's what that does to you, made concrete. And this is a real example from the middle of 2026. So take the number as a snapshot, not a law. One of the most anticipated companies of the decade finally went public. Retail demand blew past a tiny retail slice. People who requested 1,000 shares got filled 17, and then told by the app, congratulations. That's the whole mechanism. One number you'll forget, one feeling you won't. The lottery isn't a way in early. It's a way to be let in last, at a markup, and handed a ribbon for it. You weren't offered a seat in the room. You were offered a raffle ticket for the crumbs and a notification designed to make the crumbs feel like a win. So say you win the raffle, you've got your 17 shares. Now the pop, the number everyone screenshots, the stock opens and rockets, the headlines cheer, and you feel it in your gut that you should have been in. Here's where that pop actually comes from. It's not the market discovering genius in real time. It's a decision made on purpose by the bank. The bank sets the offer price deliberately below what it thinks the shares are worth. Too low on purpose. There are dry reasons. Reward those honest institutions again. Guarantee a clean debut. Buy a day of flattering headlines. But strip the reasons away and look at the mechanic. The gap between the low offer price and the high first day price has a name on Wall Street. Money left on the table. It's a real transfer. Out of the company that sold too cheap into whoever was holding shares at the offer price before the open, which is never you. The pop you're cheering is a receipt. The exact size of the gift measured to the penny handed to the people already inside. And the game is rigged in the footnotes. Those first days, brokers have punished you for flipping too fast. Holds, penalties. The institution beside you flips the same shares free. One more mechanic, because it explains the madness. In the first days, there's often no way to bet against a new stock. No shares to borrow to short it. No options yet. So everyone who thinks it's overpriced is locked out of saying so with money. Only the believers can act. That's not a market finding a fair price. That's a room with the doubters gagged. Here's a finished version, and I'm dating it on purpose. This one's from 2025, so the whole shape is visible. A payments company priced its shares in the low 30s. It opened in the high 60s, already gone. First day close, up over 160%. The crowd kept buying. It ran toward 300. Then reality arrived, and it gave back about 70% from the peak. The people holding the offer price won before you woke up. The people who chased the pop bought the top of a curve that was always coming back down. The pop isn't a gift to the public. It's the bill the public pays for a price set too low on purpose for someone else. So the smart move is obvious. Don't buy day one. Wait. There's real wisdom here, and it has a mechanism behind it. The lockup. When a company goes public, the insiders are barred from selling for a window. Founders, employees, early funds, all locked up by contract, usually 3 to 6 months. It keeps them from dumping on day one and tanking the debut. But a lockup doesn't delete those shares. It delays them, And the day it expires, the shares that can suddenly hit the market multiply overnight. All that supply unlocked at once, and more often than not, the studies back this up, the stock sags right around that date. So the folk wisdom says, let the lockup pass, let the flood come, let the price find a real floor, then decide. Decent advice, not clean advice. Because not everyone's locked up the same. Some insiders have early release triggers written in. If the stock trades high enough, long enough, they unlock early. So a spectacular debut can quietly speed up the exact selling that later drags it down. And the biggest names can be locked far longer than the rank and file. We're watching one of those long founder lockups play out on a huge company right now. That's as this is being recorded. Whether it goes the way the theory says, you'll know by the time you're watching this. And here's the twist that should bother you most. You can swear off the lottery, ignore the pop, never touch an IPO by hand, and still end up owning it. Because when a new stock gets big enough, the big rules-based index funds are forced to add it. By rule, which means your retirement account, quietly tracking that index, buys it for you. Automatically. Near the top. You never clicked a thing. There's no clean entrance. There's just the flood, the folk wisdom, and the money that buys the top on your behalf while you sleep. Fine. You do it anyway. You buy, you hold, you're patient, you do everything right. Long term, does any of this actually cost you? The honest answer is, on average, yes. And I want to be careful here because this is the part people oversell. Academics have tracked decades of IPOs, and a pattern keeps surfacing. The average newly public company underperforms a similar, already established one. That gap shows up over the years that follow. $1 in the typical IPO tends to grow slower than $1 in a boring, proven peer. Not a catastrophe, a drag. A quiet tax for buying the exciting thing at the exciting price. Now the honesty, that finding is real, but its size is argued over. Measure it a different way and it shrinks. It's much weaker for big, already profitable companies than for tiny story stocks. So take the direction seriously and the magnitude with a grain of salt. Because here's a distinction that survives all the statistics. A great company and a great investment are not the same thing. They're separated by one word: price. Picture the most valuable software company in the world at the turn of the century. The business did everything right for the next 10 years, grew, dominated, printed money, and the stock spent more than a decade below where it closed in 1999. Not because the company failed, because the price had already baked in a perfect future. You can't outrun a price that already assumed you'd win. And yes, sometimes it works. Buy the right one on day one. Hold for 20 years. Compound at a rate that changes your life. It happens. But you can't pick that one in advance. And even the real winners put their earliest believers through drops of half their value. More than once. Before it paid off. Being right wasn't enough. You also had to survive being right. A great company at a price that assumes perfection is just a slow, respectable way to lose 10 years. So here's the whole thing in one line. The line you were standing in was never about money. It was about which room you were in and which legal category your name fell into before the stock ever traded. And retail, by design, was never in a room. You didn't miss the IPO. You were never going to be in it. And once you actually believe that, something loosens. Because you can stop grading yourself against a game you were never dealt into. There are only two moves left that the evidence actually supports. 1, if you love the company, don't chase the open. Let it trade. Let a few real earnings reports show you what the business actually is. Not what the hype says. Then buy the fundamentals, not the debut. 2, skip the single pick entirely. Own the whole market. Let it fold in every new winner on its own schedule. You never have to win a lottery. You never have to beat an institution to a share. Neither one needs you to be early. Because early was never yours to buy. It was a one thing the line was built to keep from you. The pop was never yours. The allocation was never yours. The ground floor was never yours. But the choice to stop paying to feel like you missed it, that one finally is